Okay, so hopefully you've watched part one and part two. Part one dealing with how and why inflation tends to run hot. Hint, it's by design. And part two deals with who's getting screwed in this charade and what asset class in particular is most susceptible to losing you money in real terms. So I'd highly recommend watching those first before digging into the solutions we discuss now. I'll start out with a simple, obligatory answer, which you would likely get from a financial advisor, but I'll also tell you what to watch out for when being advised in this manner. And then I'll move on to some more interesting solutions. So in 2022, when inflation was really starting to creep into the picture, I heard the talking heads on CNBC telling us we should be buying dividend stocks, in particular, dividend stocks with the ability to pass on price increases to the consumer discretionary often. In broad strokes, it's not terrible advice, and here's why. Theoretically, let's imagine that Disney, for example, paid a decent dividend. It pays a small one, but let's imagine it's an attractive one. They were generating plenty of income at the time to pay a higher dividend if they wanted. So inflation goes crazy. Disney has to spend more on everything from content creation to employees at their parks to insurance. So not the end of the world, because in near real time, they can start to raise their ticket prices and subscription costs to adjust to the new world and maintain their existing margins. So theoretically, from an academic perspective, Disney could have been a decent recommendation. Now, Disney at that time, 2 or 3 years ago, when inflation was tame and was starting to enter into the picture, it was nearly a $200 stock. And recently, it bottomed around $78. So that wouldn't have worked out too well. So I won't go into too much detail about Disney and why it declined, but suffice to say there are other factors to look out for. So another recommendation, sort of a derivative of the dividend recommendation you might have received, is to buy a company that's growing sufficiently fast and reinvesting in their business rather than paying the money out in dividends. Dividends themselves aren't necessary for that inflation protection. So Disney, in its actual form, would have met that criteria and would have actually been able to pass on the increased costs to the end consumer without much lag. So again, that clearly didn't work out too well for Disney shareholders. Now, let's not cherry pick a single company. What about investing in banks, right? Banks theoretically borrow short term, meaning they borrow in the overnight market or in relatively short duration fixed income securities. And so that costs them very little interest. And then they try to lend longer term as spread above their cost of capital. So they get a premium from lending longer term and they charge a spread above their own cost of capital. So theoretically, your advisor might have suggested that banks actually benefit from higher rates. Why not buy banks? And that would generally be a true statement, but that's certainly not what played out. Let's think about what happened to regional banks. If you'd bought the regional bank index, a nice diversified pool of regional banks, you'd be down about 50% over the last year or two. So that also didn't work out very well, despite common wisdom saying that buying banks in a rising interest rate environment is a good idea. And you might say, oh, well, again, you're cherry picking. Regional banks, yeah, they had, a whole host of issues that, who could have predicted? Well, even if you go to the big banks like Bank of America, which theoretically was the beneficiary of the turmoil from all the regional banks, well, Bank of America, from its highs in January of 2022, went from 46 down to more recently 26. So same thing, not a particularly attractive return. In fact, about a 40+% loss. So again, maybe cherry picking a little bit because there are some mega cap banks that actually held up reasonably well, but there really aren't many that are up. And just held up. That's not really a great outcome either because again, remember, we're trying to combat inflation here. So you had inflation working against you over the last 2+ years. And so you really haven't gone anywhere. In fact, you're down probably. So common wisdom hasn't really been helping us here over the last couple years. And then there's real estate and REITs. And real estate, I've been told, is a great hedge against inflation. Inflation rises, you renegotiate your leases, and you bump up those leases to ensure that you're keeping up with inflation. Well, it hasn't quite worked that way. Certainly not for commercial or industrial to a lesser extent. In fact, it's been a bona fide disaster if you've been in some areas of commercial real estate, for example, office towers in some of the major cities. I'm seeing transactions in some cases, on the rare occasion, that price back at 2014 prices already, which is just hard to even fathom. And then I'm seeing REITs that are down, 60 to 80% in some cases. And like the banks, the REIT indexes are doing no better. They're down probably more than the bank ETFs, I would say. I won't dive too deep into what is causing the REITs to decline as much as they have, but suffice to say there are multiple issues compounding the problem. Okay, I thought you were providing some solutions here. Well, it's a bit tricky because there is no silver bullet. No, not even Bitcoin. Most likely, the surest bet, however, in an inflationary environment is buying wonderful businesses with very low capital needs. That means staying away from businesses with significant near-term debt maturities, negative operating cash flows, or needing to invest heavily to maintain productivity or output. A company that would very much fit the bill, the opposite of that, is Apple. As boring as it is, Apple has extremely low capital needs since it generates such an enormous amount of cash. It has the ability to pass on price increases to users of its ecosystem and its phones, its hardware. Now there's a less obvious answer. And this is especially so when equities in particular were so overvalued right before inflation picked up. And that answer, I would suggest, is cash. Wait. I thought you said the dollar I'm holding is eroding at a concerning clip while inflation rages around me? Well, yes, it is. But if you've heard of the cleanest dirty shirt theory, this is a bit of a twist on that. Yes, it's brutal and unenjoyable to be earning a negative real rate of return on short-term cash. Call it 3-month T-bills, for example. What inflation is hurting more is valuations. Stocks are disproportionately hurt by inflation expectations rising. Remember, what a company's value is it is the net present value of all future cash flows, discounted back to today. Now, without making this into a university course about net present value, the gist of it is that a company that used to trade for a 10x multiple after a good round of inflation might now trade at a 5x multiple. Practically what that means is that all else equal, your favorite stock was just cut in half by no fault of its own. So having cash on the sidelines ready to deploy is incredibly strategic and can yield some incredible results. So imagine you sidestepped equities being crushed by increasing inflation expectations and an ever-increasing discount rate, which is a component of the net present value calculation, which forms a company's current value. So imagine you sidestepped that, you bought a company that was down 50%, and then that company recovered over time, you'd earn yourself a 100% return. So yes, you paid the price up front by being harmed by real rates being negative or inflation being higher than the interest collected on your bills or your cash. But you got the benefit from the aftermath of multiple compression on stocks. Now, in this sort of environment, there are some other really interesting opportunities that arise as well, outside of stocks. And I'll dive into that on the next episode. Now, you're probably thinking, who would have realistically gone to cash in 2021? You would have had to have been pretty convicted that the market was done going higher and severely overvalued. Well, for the record, I took this one step further in 2021. I wasn't just sidestepping the valuation compression that was beginning and that I was expecting. I was actively seeking to benefit from it by being short stocks. So don't tell me, who could have known you can't time the market? Well, yeah, it's hard, I get that. But sometimes things are fairly obvious. And I would argue that what's happening right now in the market is another one of those, this is actually fairly obvious moments where a lot of money can be made should we be fortunate enough to get it right again. So in the next episode, we'll talk about a couple other inflation combating strategies. Not shorting though, that one is just too hard and should only ever be used sparingly when the dominoes are already starting to fall. There's a saying that I've had to learn the hard way, and that's that the market can be irrational longer than you can be solvent. That statement is something that you should always have in the back of your mind when investing, heaven forbid shorting. I feel like I was on the correct side of history with regard to all these meme stocks and SPACs and all that sort of thing. I was typically shorting a lot of them where I felt I could without getting burned too badly. Because I knew the valuations made no sense. I knew that it was, in some cases, just really junk being issued. I mean, literally every company that was going public, it felt like, through these SPAC mechanisms, had $10 billion valuations. Like, not every company is worth $10 billion, but in 2021, it seemed like everything was. So anyway, yeah, as I say, not for the faint of heart, not something I would ever recommend, but I felt like I had no choice at the time. Okay, thanks everyone for joining today. Please don't forget to like and subscribe. It lets me know you find some value in what I'm sharing here and will encourage me to keep sharing tidbits of knowledge as I come across them. Okay, thanks again for listening to the 400K Investment Project. And on that note, if you aren't also following the portfolio series, just a very brief update. The growth portfolio is today up 23% from inception, and the growth levered version, the levered version of the growth portfolio, is up 30% today from inception, so 35 days ago. So, very, very strong initial results. Hopefully we can hang on to those results and build from them. So yeah, thanks again for watching. We'll see you next time.